If you enjoy listening to The Bid, you'll love reading it too. The Bid's monthly newsletter brings together the same sharp insights and big ideas you hear on the show, from the minds shaping markets and investing today. Each edition breaks down what's driving markets and what it could mean for your portfolio in just a few minutes. Subscribe for free at blackrock.com/thebid. The Bid, ideas that move markets. Welcome to The Bid, where we break down what's happening in the markets and explore the forces changing the economy and finance. I'm Oscar Polito. As we wind down for the holidays, we thought it would be a good opportunity to reintroduce you to our short-form podcast, Market Take. Market Take is a quick, weekly digest on what's driving markets, investing insights, and analysis across asset classes, investment strategies, and borders. If you like The Bid, check out Market Take wherever you get your podcasts and enjoy the next couple of episodes right here in the Bid's feed. If you need some bid content, check out the 2026 Outlook, where Jean Bovin leads us through his thoughts about what opportunities investors may expect next year.
What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Nicholas Fawcett, Senior Economist at the BlackRock Investment Institute. This week, we discuss how signs of the US labor market softening tease up another interest rate cut from the Federal Reserve. The Federal Reserve looks poised to cut interest rates for the third time next week. We think it's warranted. Why? September payrolls and recent jobless claims data highlighted some cooling in the labor market. The Fed has cut rates twice this year and put a weakening labor market at the center of its decisions. Policymakers worry that the jobs market could get weaker, so rate cuts were needed to get ahead of that risk. The Fed has a harder time understanding the economy given data delays tied to the long government shutdown, but the September jobs report and other data show the labor market in a no hiring, no firing stasis. Both demand for workers and the supply of workers have fallen, with the latter due to a sharp slowing of migration. That has pulled down the break-even level of payroll gains that keeps the unemployment rate steady. It could also explain why wage growth has also held steady, and the unemployment rate has only risen slightly this year. The delayed data includes both October and November jobs numbers. They're likely to be noisy and will come after the Fed meets on December 10th. October's report will include deferred federal government layoffs that may cause a sharp drop in employment that month. But we think the Fed will have considered that in its previous decisions. Markets are mostly pricing in a quarter-point rate cut next week. We agree, and think a softening labor market gives the Fed reason to cut further. That's different from earlier this year, when the Fed was facing calls to cut rates even with data showing strong job gains. Those calls highlighted the policy tension between tackling sticky inflation and keeping US debt sustainable. The Fed now has a path to cut rates without raising questions around its independence, even as inflation holds well above its 2% target. But if inflation were to accelerate next year due to stronger activity or renewed hiring, those tensions could re-emerge and drive long-term bond yields higher. Part of this tension stems from persistently large US budget deficits. The opposite is happening in the UK. The government is trying to reduce its deficit and even achieve a surplus on a 5-year horizon in the latest budget. The UK Chancellor delivered a positive surprise with various revenue raises boosting the buffer between government revenues and spending by more than expected. This shows how the UK needs to strike a balance on market and political credibility and has done so for now, even if tax revenue as a share of GDP is set to hit a record 38% in 2030. Here's our market take. We stay neutral on UK gilts as the new budget front-loaded spending and back-loaded much of the tax gains. Yet we have a relative preference for gilts on a strategic horizon of 5 years or longer, thanks in part to a lower neutral rate, one that neither stimulates nor hurts growth than other developed market government bonds. We think a Fed rate cut this month is in play, as other indicators show the labour market softening. That backdrop, along with the AI theme, underpins our pro-risk stance. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to Market Take wherever you get your podcasts.
Thanks for listening to this episode of The Bid. Next week, we'll be back with another Market Take, but you can expect a new episode of The Bid after the holidays in January, where I'll be talking to Carrie King about her stock picks for 2026.
This content is for informational purposes only and is not an offer or a solicitation. Reliance upon information in this material is at the sole discretion of the listener. In the UK and non-European Economic Area countries, this is authorised and regulated by the Financial Conduct Authority. In the European Economic Area, this is authorised and regulated by the Netherlands Authority for the Financial Markets. Reference to the names of each company mentioned in this communication is merely for explaining the investment strategy and should not be construed as investment advice or investment recommendation of those companies. For full disclosures, go to blackrock.com/corporate/compliance/bid-disclosures.